Okay, welcome back to Learning Object 6 of the Chapter 6. In this learning object, we wanted to continue introducing the inventory costing, right? So now we wanted to learn how to apply lower of the cost and the net realizable value of the inventories. So what does that even mean? Okay, let's see. When the value of the inventory falls below its original cost, right? And companies are required to report inventory at a lower net realizable value. So there, you tell me, what is the net realizable value? Net realizable value is essentially the selling price of the inventory in the ordinary course of business. Is less than any cost of completion, disposal, and transportation. In other words, when your net realizable value, meaning that the cost that estimated to sell whatever left in your inventory is actually not even recoverable from your freight-in charges or the original purchase price that you bought for that product, that means your product is actually devaluing so fast, right? For example, a car is a great example. Once the new model comes in, the old model is basically selling cheap, and then the more new model, the more fancier model comes in, the more faster, the more different line of product you produced, the older generation of the car is gonna be sell lower and lower and lower price. To extent that the selling price is actually so low, to extent that it cannot even recover the original cost that you pay to your vendor, to your suppliers. Hence, that the net realizable value of that inventory is really low. So once you determine that the both cost and the net realizable value of the inventory, you have to report the unsold inventories, right? So how do you report that? If you find the net realizable value is actually lower than your cost, so you have to reduce the inventory from the cost to the net realizable value and report an expenses for the reduction, and this expense is gonna park at inventory for the previous period. Debit cost of goods sold and credit inventory. And then this because your net realizable value is less than the cost. And if you find your cost is still less than the net realizable value, meaning the selling price of the product, then there's no need for your year-end adjustment to bring down the inventory account. I want to give you more example for this. Let's look at this. Fun Station, still at the Mario game shop. They have a quantity of $15 per 300 units as a cost, which is 4,500. And then they have another product, Fun Station 3, 20 of them, and the purchase cost, the cost of that station is $400 each. Hence, the total for that specific batch of product is 8,000. However, when you find that the Fun Station 2 is no one play anymore, no one even want to buy, even you want to sell it on the market, it actually can sell only $200. Hence, that this 15 units, if you sell, it can only sell $3,000. On the other hand, the Fun Station 3 is still can sell 450, which is higher than the cost of 400. And then you have 20 units, you can sell for $9,000. In this situation, we wanted to write down the inventory cost of the Fun Station 2 because we wanted to always record a lower cost and the net realizable value, because at this scenario the selling price is even lower than the cost. Hence, we want to bring down the inventory account to the selling price. So therefore, the year-end adjusting is gonna be 4,500 minus 3,000 is gonna be 1,500. On the other hand, because the net realizable value of the fund station 3 is still higher than the cost, therefore we will record the ending inventory of 8,000 at its cost without doing any adjusting entry. And then at the end, after you bring down the fund stations to 3,000 as ending inventory and keep the 8,000 of fund station 3 at 8,000, we have an ending inventory of 11,000, and we need adjusting $1,500 for the fund station 2. How do we journal it? We journal it by crediting out this 1,500 to reduce the total inventory account and debiting this depreciation or devaluation of the product to the cost of goods sold as an expense account. Okay, reiterate what I just said again. We needed to reduce the 15 units of fund station 2S from its original cost of $4,500 to lower net realizable value for 3,000 with the following year-end adjustment. Okay, let's do a quick example for this. At the year-end, the company reported the following inventory amount. They have a 100 A product, 150 of B product, at $4 for A product, at $8 for B by purchase, when they purchase from the vendor. However, the net realizable value is A product still high at $8, right? So, however, the B product, the cost actually is bigger than the net realizable value. So therefore, in order to calculating the ending inventory account of this company, we will pick the lower of the cost or net realizable value. So lower cost or net realizable value of A should be cost, and B product should be $6. So therefore, 4 multiple 100 is 400. 8 multiple 150 is gonna be 1,200. So therefore, we're gonna okay, so $900. Oh, sorry, 6, right? 6 multiple 100 is $900. So therefore, we need to choose D, 1,300. Okay, because we picked the lower value of net realizable value instead of 8. Okay, and then at the same time, how much should we write down in terms of inventory accounts? Is this because we will write down from 8 to $6 is a $2 piece, and then multiple 150 is $300. So we need to reduce inventory account for $300 by debiting cost of goods sold for $300 and crediting inventory for $300. Right? So we choose A. This reflecting the conservative of accountant. We only want to counting the lowest possibility, meaning that if the cost is lower than the selling price, we keep the cost as what it is. If we find that actually the cost is not recoverable from selling because the selling price is so low, we need to reflecting the drop of our asset, the shrinkage of our asset, because it's outdated, immediately by writing down the inventory by using the net realizable value of the inventory. Okay, so now we are going to analyzing the management of our inventory by using inventory turnover ratio, which we learned a little bit the AR ratio, right? Accounts receivable ratio and a gross profit ratio. So the inventory turnover ratio in nutshell shows that the number of times the firm sells the average inventory balance during a reporting period. So the amount of cost of goods, it equals the amount of cost of goods sold dividing the average inventory, right? So in other words, how many times you can turn over. So if your cost of goods sold is higher than the average inventory, means that you sold multiple times. You don't let the inventory stay inside of the warehouse. You flip them several times, right? So, and another thing is the average inventory, of course, is going to be the beginning inventory plus the ending inventory and dividing it 2, okay? And then once you get the inventory turnover ratio, remember we also have average days in inventory or average days in accounts receivable by using 365 days dividing the inventory turnover ratio to understanding how fast the inventory is turning in terms of how fast the product is sold from warehouse to the customer. How many times out of 1 year, number of days that the average inventory is held. Let's give you an example. For the Best Buy, the cost of goods sold of the current period is 20,963, and the average inventory is only 4,957, and then that means they flip the inventory turnover 6 times a year, and then when you're dividing 365 dividing 6, that means the average inventory held by the warehouse is only 2 months. However, when you look at the Tiffany, which is a jewelry store, their sales revenue is 1,512. I believe this is in millions, okay? And then dividing the average inventory on hand, of course, their turnover of the inventory only 70% of the time the inventory can be sold, okay, over the year. Therefore, that means that about 2 years almost, all the inventory, the holding period of each inventory or each jewel in the Tiffany store is about 2 years holding in the warehouse, right? The average days that the inventory stayed in the Tiffany's warehouse is about 2 years. If the two companies had the same business strategy, this would indicate that Best Buy is better at managing inventory than the Tiffany. In this case, though, the difference in the inventory turnover relates to the products the two companies sell. Best Buy sells most commonly household products, right, such as the TVs or computers and electronics accessories, while Tiffany sell very, very expensive jewelry like engagement ring that takes time to sell to the right customer. Therefore, this does not really mean the Best Buy is better than Tiffany. It's just because their business strategy is different. Okay. So that means that we cannot really only by looking at the turnover ratio, inventory turnover ratio, or average days in turnover, to judging a company's operation strategy. We also needed to look at how is the profitability of the company ours, right? To deciding which one we should invest in. By looking at these two ratio or statistics, we can only think that Best Buy sell the products much quicker than the Tiffany. Okay, so let's just first do a quick example. Net sale 100,000 and cost of goods sold is 70,000. Inventory balances for the past 2 years are 10,000 and 20,000. What is the inventory turnover? So basically, turnover ratio is equals the cost of goods sold. Cost of goods sold dividing the average of the inventory. Average of inventory equals the beginning inventory plus ending inventory dividing 2. So therefore, we get 4.67 times per year. And then, since we keep talking about the example, that we wanted to also judging the company's profitability. So the best indicator is actually gross profit ratio. It's an indicator of the company's successfulness of managing the inventory. Measure the amount by which the sales price of inventory exceeds its cost per dollar of sales, right? We use the gross profit dividing the net sales. Similarly, we use the Best Buy and the Tiffany's example. For Best Buy, the gross profit is 24% by using the gross profit dividing net sales. Tiffany is actually 62%. This means that Tiffany's inventory turnover is much lower than the Best Buy. However, Tiffany's product profit margin is really high. And the product Best Buy sell are familiar goods, such as competition from companies like Walmart or Amazon for these high volume items keeps the sale price very low. Hence, that Best Buy is hardly to make any exceptional profits, right? Because if they charging too expensive, people can turn into alternative sellers. And Tiffany, on the other hand, they are very specialized and customized jewels. So therefore, their competition is in different area, right? It's in different track. So therefore, they can charge a higher market margin, profit margin. In a nutshell, the inventory turnover ratio indicates that the number of times the firm sell or turnover its average inventory balances during a reporting period. The gross profit margin measures the amount by which sales of the inventory exceeds its cost per dollar of the sale. And now I just introducing this topic because I think it's just brushed on. A lot of people don't even talk about it, but I do want to talk about it because this is actually help us deepen our understanding, but I'm not going to examine it. So, and also this is related to earnings management. If you are in a higher level class or you want to do accounting research, people has written multiple papers on inventory error, but in those papers or in those instances, people really do in the inventories playing ending inventories number to make sure the ending inventory is either low or high, depending on what their purpose, either the tax purpose or the profitability purpose, right? So that way it's so-called carry the error to the future period. Okay, I want to introduce this for just a quick second and then maybe just for your entertaining purpose. Okay, so first of all, in order to calculating cost of goods sold, we're usually using periodical system, or we always have a FIFO or LIFO cost assumptions. And then the biggest determination of these two methods or cost of goods sold determinants is to split the cost available for sale between two rows. One is the ending inventory, one is cost of goods sold. So it doesn't necessarily, it's not always a 50-50, right? It depends on, it can be cost of goods sold is a lot less, or it's a lot more, right? It depends on the situation. But when there's error made on the ending inventory side, it can cause a very different financial statements. For example, at the beginning inventory plus purchase plus ending inventory equals the cost of goods sold, and the ending inventory is considered as asset and parked on the balance sheet, right? And the cost of goods sold is actually expense, is parked on an income statement. And this two things is either you high or I low situation. Either you have a high inventory, if you have a high ending inventory, you will definitely have a low cost of goods sold. If you decide to have a higher cost of goods sold, you will definitely have a low inventory. Okay, so summary of this effect is that when you overstating ending inventory, you are actually, if there's error made, you overstated the ending inventory, you will understate the cost of goods sold, right? If you understate the cost of goods sold, of course you're gonna overstate the profit because your expenses is lower, right? And then if you overstate the gross profit, you will overstate your net income, and then also you will overstating your return earning account. Okay. However, on the other hand, if you underestimate or understated your ending inventory, you will overstate the cost of goods sold, because those two things are eating one pie, right? I just talk about the pie is split between cost of goods sold or ending inventory. Either ending inventory is high, cost of goods sold low, or ending inventory is low, cost of goods sold is high. In another word, when you underestimate the ending inventory, you are essentially overestimating cost of goods sold. And when you overestimating cost of goods sold, that means your expenses is very high now, and then you will understate your gross profit. Essentially, you will understate your net income, you will understate your return earning. And also, if there's a relationship between year 1 and year 2's inventory level, because there's a linkage between the ending inventory of year 1 will become a beginning inventory of year 2. So in this year, if you understated the ending inventory of year 1, then you will have understated the beginning inventory on year 2. At the end, you on year 1, because your understatement of ending inventory, you will have overstated of cost of goods sold. On the other hand, because your ending inventory beginning inventory gathered from the year 1 is understated, you will also have cost of goods sold understated in the year 2. And these two actually wash out. Let's use a more exact number to show you. So this is the correct inventory account. Basically, the ending inventory should be 500 and the cost of goods sold should be 3100, right? And then the correct number of 500 carry to the year 2 of 500, and then therefore the cost of goods sold of the next year should be 3700. However, and then both of these years the cost of goods sold add up should be 6800. If you incorrectly put the inventory number, say you reduce the inventory number on the ending inventory for 2021, you will carry that ending inventory for less than $400 to the year 2022. And then you will end up with having cost of goods sold of year 2022 for only 3600 versus 3700 of cost of goods sold. But comparing to the cost of goods sold for 2021, the mistaken one will be overstated for 3200, and the cost of goods sold should only be 3100. But when you add in cost of goods sold together for these 2 years, those two washed away. So in other words, when you underestimating ending inventory, you are overestimating cost of goods sold for this period. But when you carry that underestimated cost of ending inventory to the future period cost of goods sold will also be underestimated. In the key point is that in current year, inventory errors affect the amount reported in the inventory and the return earnings in the balance sheet, right? Because when you're underestimating ending inventory, your asset side, the inventory, is underestimated asset, but the balance sheet, right? And then your liability side don't change, but your return earning is going to be lower because your net income going to be lower. So therefore, you will hit the balance sheet twice. The inventory reduced and the return earning reduced. Hence, it's balanced. Okay. And also, the amount of reported cost of goods sold and the profit in the income statement. So in another word, on the income statement, your revenue and your cost of goods sold, because you are underestimating the inventory account, so your cost of goods sold goes up and your net income goes down, right? So therefore, your profit and the cost of goods sold is going to be overstating in the income statement when you when you have a arrow affect the amount recorded in inventory. At the end of the following year, this is another important thing. At the end of the following year, the arrow has no effect on the ending inventory, right? Because it's gonna wash it back or return the earning. Because the ending inventory gonna grows back, and return earning gonna grows back. But the reversion of the cost of goods sold and will hit this is year 1, and in income statement of year 2 is that you're gonna have a cost of goods sold, much smaller cost of goods sold, and your net income in year 2 gonna be increased. Okay. So let's see. The inventory error that underestimates the amount of ending inventory will result in which of following in the current year? A. Overstate the cost of goods sold. Exactly. Because you reported less ending inventory in current year, of course you're going to overstate the cost of goods sold, because those two are adding relationship. A, which is a fixed amount, equals the cost of goods sold plus ending inventory. So when this goes down, so the cost of goods sold of course goes up. Okay, so in this chapter we covered a lot of information. First, we introduced what is the cost of goods sold, right? And then we want to show you how to do multiple steps income statement. And then we talk about the cost assumption. And there's three major ones: FIFO, LIFO, and weighted average. And we say FIFO is good for profitability, and LIFO is good for tax return purpose, and weighted average does not have any preferences or benefits, right? It's in the middle ground. Hence, the tax authority saying that if you use a LIFO to report to our corporate tax return, then you should also use LIFO on the financial reporting purpose. That's called the LIFO conformity rule. And the third one, we talk about how to journal, right? Journal is talk about how the accounting system is setting up. There is two accounting inventory system. One is the perpetual system, and one is a periodic system. So perpetual system namely means that you trace inventory continuously, meaning that you always debit credit the purchase and then debit inventory, credit accounts payable, and when there's a sale you debit cost of goods sold, and then you credit the inventory. But the periodical system is different. You do record purchase, but you record as a temporary account, right? And then in the end, only debit cost of goods sold and credit inventory at the end of the period, and restate ending inventory amount and credit out beginning inventory amount, right? So therefore, this is a very special way to calculating cost to summarize cost of goods sold account, to journal cost of goods sold account, and this is a cheap way of maintaining an inventory system, costing system, and this is a very expensive way to do that, right? And the fourth part is we talk about what is the cost lower than net realizable value, and this is essentially means the selling price. So when you find your unsold inventory or ending inventory is actually each unit cost is actually higher than the price that they can sell, you have to write down your inventory account, because your inventory is not worthy as much as you thought it is, right? And then we talk about the inventory turnover ratio and average days of inventory. And then we also talk about the profitability ratio, which is gross profit ratio, to comparing different companies' strategies in terms of how they managing inventory, and how do they charging the customer, how do they recover the cost based on their competition of the peers and their strategy of the company. And last thing, we talk about the errors. We said inventory errors were impacting the balance sheet, so account the inventory account, of course, and the return earning account. and also it will impact the income statement as well. But in year 2, we said they will not have an effect on the inventory account, but it will have a severe effect on reverse the income statement in year 2. It reverse the impact of income statement of the year 1. Okay, so I just summarize, and you don't need to worry about any of this arrow thing, but the most important thing is 2 and 3. Okay, so if you want to review the video or the homework, I suggest you focus on the learning objective 3 and 4, learning objective 5 and 8. Okay. Of course, you need understanding what is a merchandise company and what is a multi-step company, and then know how to calculating ratios as well. Okay. So thank you for your attention, and I will see you guys in the next video, next chapter.